You have all the non-bank entities that are now trying to become banks as well, and or they're getting Fed accounts. They're looking to do that. So those are also that you don't have time to wait to come up with a strategy, and you need that strategy to figure out how long I got before I need to be doing things that keep my customers, but also attract that next generation. It's not just keep what I got, but how do I get new customers? Because I'm losing them in sieves right now.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hi, everyone. Welcome to Wrestling Payments. I am very excited. I have Steve Wasserman, who has been my number one podcast episode of all time. Biggest hits, most attention. And from the world of, it's a small world, I got on a webinar to learn about stablecoins. And there was a speaker on there, and his name was Larry Pruss. And all of a sudden, I am doing a podcast with Steve Wasserman and Larry Pruss. Guys, can you introduce yourself? Larry, you go first. You're the new guy.
Sure. So obviously, name's Larry. I work at Strategic Resource Management. I'm in the consulting space. We're an advisory firm. We advise primarily financial institutions, but also fintechs on all things related to payments. My personal responsibilities are around kind of the emerging disruptive payments.
Steve Wasserman. My organization is Vments, and I've been involved in payments for many, many decades from a couple of different perspectives, from consumer bill payments to the B2B payments. And I've been involved in the FPC since it started. And lately payments was started when I got very interested in digital currencies back in 2017. I actually filed a patent for it. That was bank issued stablecoins back then, or you call them tokenized deposits as well. It's an interesting design. Someday it might be very valuable because the things that are going on now are finally starting to scratch the surface on what was designed back then. But I'm trying to leverage my expertise and experience more than my patent itself, and in teaming up with people like Larry to help financial institutions with their strategy, and then later on with their execution of those strategies.
Excellent. So it's really interesting because there's always that, payments is changing so fast. The future is coming. Future's kind of here. The beginning of the year, there's going to be a stablecoin law. Maybe there isn't, maybe there is. And all of a sudden, we're now in the fall, there is a stablecoin law. You literally did this work years ago, 8 years ago, and we've come kind of full circle. When we had a little pre-meeting, you guys said you were working with credit unions. I really just want to step back, and I'd love you to tell me what you're doing, what's going on, what are key points people should know, that bankers, credit unions should know about what's happening right now. So I'll turn it up to you.
Yeah, so let me go first. So it's not just credit unions, banks, financial institutions. One of the key things to know is, as you mentioned, the future is here. Stablecoins are already processing a huge amount of value movement worldwide. It's about 49 trillion currently. The circulating supply is about 315 billion. By the time your users hear this, it will probably be significantly more. It has largely been used internationally for cross-border transactions, P2P, B2B type transactions. And we haven't seen it here largely in the US, but primarily because the Genius Act hadn't passed, or we didn't have any regulatory guidance. We now have that regulatory guidance. So there was a rush for everyone to learn about stablecoins, tokenized deposits similarly, and get involved with them. And one of the main reasons for that is that stablecoins essentially don't have any intermediaries, right? They transact on kind of public permissionless blockchains. That lack of intermediaries reduces kind of the economics associated with that. It reduces the number of intermediaries from, 4 or 7, depending on the type of financial transaction, to essentially 1. And so we're seeing all of the players, whether they're the merchants, the banks, the credit unions, the processing companies, the payment companies, everyone's rushing in to understand this and get themselves a strategy. You really need a strategy first before getting into market with a solution.
I guess I can add to that.
Anything to add? Yeah.
Well, I mean, the strategy is definitely, you have to have a strategy before you do anything. And, it's important now to establish that strategy and be able to allow your customers and your partners and all the other parties that you deal with, that you have this strategy and it's coming, even though you don't necessarily go live with it right away. And then you need to, plan out the implementation plan of going out live. And then the execution plan is the execution of that implementation plan. So, you're probably still looking at, before you actually have something that's running for your customers in financial institutions, that it may still be, late 2026 or even after that. But you need to prepare now and not lose those customers, because there are non-bank entities and fintechs and such that are attracting customers away from your deposits, away from your transactions, and you need to be able to keep them and retain them, and that's the importance of it. And Larry talked about some use cases. Those are obviously key use cases. B2B was a big thing because I was involved in B2B for many decades in the ERP side of things, so I can appreciate where that the value of with stablecoins could be very helpful. The instant payments are also helpful, as is, Save the ACH, that, certainly our ACH associations appreciate that's still there, but they also provide training on instant payments with AFPP programs. So been involved in that. I'm an AFPP myself, and so believe in all of it. And one of the other things I didn't mention in my introduction is I'm involved in the X9 QR codes. Why that's relevant, and I'm bringing it up here, is because it crosses over traditional financial institution payments like ACH, the latest in instant payments, FedNow, RTP, as well as compatibility with stablecoins, so that when you have a QR code, whatever the merchant or the biller might want to accept, that can come across, and you don't need a directory for that. That can come across with the QR code interaction. Along with that QR code also includes its own little request for payment. It's not exactly the ISO 2022 request for payment, but I made sure it incorporated some of the same terminology of the ISO 2022 when I was involved in the collaboration of that. And so it's a really very valuable tool that I have request for payment transactions to support any of those payment rails with a consistent request for payment across all of them, as well as a corresponding payment notification that gives me the remittance detail I need to do automated processing on the back end.
So that was an awful lot. We jumped right in with stablecoins, Genius Act. I do want to get to the QR codes and pay some respect to that. But backing up just for a minute, even before the idea of you need to have a strategy, stablecoins are all exciting and shiny and ooh, how exciting. Why should institutions be thinking about or not thinking about getting into and processing stablecoins? And you did mention it, made me remember the deposit part of that. So can you talk a little bit about what should decide if an institution does want to really participate in the network?
Yeah, Joe, I'll take that. One of the things that financial institutions should be looking at is their deposit outflows and where those deposit outflows are going today. And what they'll see if they look at that is primarily going to fintechs, a lot of those crypto exchanges, and some of that stablecoin volume. We've talked to some financial institutions that are losing as much as 3% per month in deposit outflows to these companies. So that's one of the big risks is you're losing deposits. To kind of further support that, there was a Treasury study, I think it was in April, where the U.S. Treasury had looked at the potential amount of deposit flight from stablecoins in the U.S., and it was 6.6 trillion, which is probably about 20% of the U.S. deposit base. So One of the biggest reasons people need to look at stable coins is the risk of deposits flight to the stable coins. And everyone goes automatically to payments, but it's probably deposits are the first risk that you're going to see. And some of that has to do with the fact that stable coins are full reserve banking as opposed to fractional reserve banking. So these things are backed fully by treasury, cash-like instruments, as opposed to fractional reserve banking, which is what we do today, where we lend those deposits back out. So that's kind of an important thing to know. In addition to that, there's this kind of open question around yield in stable coins. And the Genius Act explicitly said you can't offer yield directly from the stablecoin issuer to the holder of the stablecoins, but it didn't address intermediaries offering that yield. So there's often revenue share agreements with, say, exchanges, crypto exchanges, and they'll pass some of that revenue on to the end user because they want to see people using it. They get trading volume, and they're basically paying for distribution to stablecoin issuers. And so there is something that feels like yield, call it rewards, call it whatever you want, getting from the stablecoin issuer. Then as these things start to get accepted, and we expect that they will, and that acceptance grows, you'll see merchants offer rewards because it's a cheaper transaction for the merchant. And then on top of that, because it's a stable coin, you can earn yield by putting into, say, a DeFi lending pool and earn yield on that. So you add all of that together and you've got yield that could be anywhere from 5 to 15%, which is more than treasuries on a financial instrument that is fully reserved as opposed to deposit. So if that doesn't scare your listeners, I don't know what will. On top of the fact that these things will eventually maybe eat into payments and impact interchange.
Steve, anything?
Larry said a lot there, and the thing is that it's not just competition of, it used to be that smaller institutions would worry about the big banks, that the big banks are eating them up, and they have been doing that for decades. So there's fewer and fewer smaller institutions. It's tougher. That you need associations, you need bankers banks and corporate credit unions and so forth to be able to help keep up with things, because you can't necessarily afford to do the types of things like a Citi or a Chase are able to do with billions of dollars that they're investing in, and that's why they're out in the market out there already, and they're leading the way. It's interesting. Citi is, for instance, they're not just doing one thing in the stable coins. They're doing stable coins. They're doing tokenized deposits. They're doing lending. They're doing all sorts of things. They're doing like 5, 6 different things, and so is Chase for that matter. And some of the other big banks are all talking about doing some other things now with consortiums, and whether or not those consortiums will be limited just to the big banks, or will the small banks need to have their own. Those are things that we're trying to help them navigate. And part of the strategy is, do you do it alone? Do you do it together? Well, together, it's hard to attack just one stone. You might need a lot of stones being thrown at it. So, and then on top of that, you have all the non-bank entities that are now trying to become banks as well, and or they're getting Fed accounts. They're looking to do that. So those are also that you don't have time to wait to come up with a strategy, and you need that strategy to figure out how long I got before I need to be doing things that keep my customers, but also attract that next generation. It's not just keep what I got, but how do I get new customers? Because I'm losing them in sieves right now.
So I'm going to do a little commentator recap, catch up. One of the things we hear at Niche, we had a kind of an introduction to concepts, just to keep everyone up to speed on stuff. So I just wanted to touch on a couple of things to make sure everyone's on the same playing field. Fractional banking. You talked about fractional banking. That's the idea. If you ever watched the video, about how banks work, is you go to the bank and you put deposits in the bank, and the bank uses those deposits to loan them out. And then those people come in and make deposits, and they use those deposits to loan them out. So there's this whole cycle of lending out of money that's deposited. With the crypto or with the stablecoin, you cannot lend that out. So if someone takes out $100,000 or $1 million in crypto, that's less money a financial institution has to lend out. Rewards. You talked about rewards. I don't often think about this, but and when I shut my mouth, I'd love you to correct me, redirect me, tell me where I got it wrong. With the reward, the idea is that if I have a stablecoin, it's not just a piece of paper per se. It could have reward attached to it. So you could get miles, you could get dollars, you could get some sort of benefit. Can't get interest, but you could get some sort of benefit. You talked about DeFi a little. Now that's really high end. That gets out there. It's the idea that I can take a Bitcoin, for instance, and I can sort of lend my Bitcoin to someone else to make a return on it. I can invest my Bitcoin as something lent out. And finally, I don't have an answer for this one. And I always hear the word and I nod, like I know what it is, but I'd love you to define the difference between a stablecoin and a tokenized deposit.
So I'm going to let Steve do that definition, and I can add to it. I do want to mention one thing. So, there's a lot of talk about liquidity in stable coins and money going to stable coins and locking it up so that the banks can't use it or credit unions can't use it for capital formation and relending and increasing the money supply and all of that. While it's true that those stable coins have to be fully reserved and you can't relend or rehypothecate those assets that are backing them, that doesn't mean hypothetically you couldn't relend a stable coin. So imagine a future where, today we take in cash deposits and we relend those back out on a fractional reserve basis. Well, imagine a future where we understand stable coins are just a cash derivative and we take those stable coins in and lend them back out and make loans with them the same way we do deposits. Now, a lot would have to change from a regulatory standpoint and accounting standpoint, and these things would have to be considered deposit-like instruments. But there is a world where that could eventually happen, and that would make stablecoins very useful for capital formation the same way that deposits are today. So there is some hope for that. But I will let Steve answer the question about tokenized deposits versus stablecoins. I'll add anything if he doesn't cover it all.
Well, I'm going to just continue from where you were talking about the lending out. The lending out is not from the issuer of a stablecoin. You can't lend out your own stablecoins. And you can, though, have received in stablecoins and be holding them and lend those out to somebody else. Stablecoins or digital assets could also be used as collateral for a loan. Back in the day, they had something called a book on your bank book. You used to have bank books back in the days. Then you're able to do a loan against your bank, the deposit in your bank book. So stablecoins is a similar type of thing. You have your stablecoin wallet account, and you can borrow against that as collateral. Or it doesn't have to be stablecoin. It could be Bitcoin or any of those other things in your wallet. But going to the question about the difference between stablecoins and tokenized deposits, it really comes down to a couple of things. The first is the reserves. We already covered this in terms of stablecoins are 100% or more reserves, because you there's this whole thing about the variability of the assets backing those reserves. The variability being the value of the underlying treasuries. So the cash portion of it is very stable. And then you have repos and reverse repos that are for it. These treasuries have to be short-term treasuries. Larry could fill in or forget how long it could be under the Genius Act. But, the others have to be more liquid. The liquid is in terms of what may be redeemed at any point in time. There's a certain number of days that you need a redemption capability to cover the liquidity of a run on that stable coin, equivalent to like a run on a bank. If a bank then has their fractional reserves, where are they going to get the money? So that's where FDIC comes in for them, protect them, but then they go into default. That's not a good thing. In the case of the stable coins, it's also the Genius Act addressed this by saying the stable coins have to be done in a separate entity or at least the account has to be somewhat segregated so that any bankruptcy related to that organization, the stablecoin holders have first dibs on the assets on those reserves. So if they're 100% reserves, they're almost pretty much 100% guaranteed to have the money unless there was some, malicious activity going on with the stablecoin issuer that didn't follow the reserves. But the stablecoin, the Genius Act addresses those periodic audits and make sure it's really there. And there's some other ways that can be monitored to track that. That's a stablecoin, 100% reserves. Well, regular deposits, tokenized deposits are like regular deposits. They have fractional reserves. They have the FDIC covered insurance, and tokenized deposits can sit in a wallet similar to sit in a bank account. So the wallet in that case is the bank account, and every bank should be able to issue a wallet. In that wallet, they should be able to not only have the tokenized deposits, but let them also accept in stable coins. And then there's a whole bunch of strategies that how they can work with those stable coins, convert them to deposits, maybe convert them to tokenized deposits as well. So many things there. Hopefully you can give some more differences I didn't cover, Larry.
Yeah, just real briefly too, for stable coins, they operate on open permissionless blockchains, which tend to lend themselves well for a global use of stable coins, where tokenized deposits are typically closed loop blockchain systems. So permissionless blockchain tend to be domestic only, although you could set up a tokenized deposit network where it would be international. The use cases also differ. So because of some of those differences that Steve and I mentioned, the use cases for stablecoins tend to be B2B, cross-border, consumer, whereas tokenized deposits, more interbank, institutional use cases. And then from a regulatory standpoint, stablecoins are covered under the Genius Act, and tokenized deposits are covered by existing banking regs. So you could do tokenized deposits today. It's going to be more limited unless you've got a consortium of a lot of users or a lot of banks or a lot of credit unions that get together to allow those things to operate interoperate. Whereas stablecoins, you've got some of that already today. But we can talk about interoperability and maybe the idea of the concept of a stablecoin clearinghouse or a tokenized deposit clearinghouse.
Awesome. I want to catch up with just another fact and then jump into the challenges folks are facing with all of this. So I didn't realize, I thought, Genius Act stablecoins. People are going to start using stablecoins. People are using stablecoins. I think I just saw a report that not only was it volume already up there, it's kind of exploded since the passage of the law. Is that correct? And can you just go right into the challenges after that?
Yeah, so it has exploded, but stablecoin's been growing at a pretty fast pace over probably the past 5 years or so. In the last 10 years, I think the market cap went from 200 million to 315 billion. So it went from 200 million to 315 billion. So it's been a big increase in market cap. Again, I mentioned before the amount of transaction value moved internationally is about 49 trillion today, which is a really large number. That is expected to double in the next year or two, which would make it around 80 trillion, which would put it on par with ACH volume. So it's really exploding. It has exploded at least in the US post Genius Act. You've got a number of stablecoin issuers like Circle and PayPal, which has PYUSD, number of others, Paxos out there, and then you're seeing a lot of partnerships. Most of that use case is still kind of international commerce, B2B type of activity, not consumer activity. A lot of people in the US still have never used a stable coin. There are some frictions to that, but that will likely change, particularly again as an alternative to deposits.
Yeah, this is where we are today. But don't blink your eye too much because tomorrow could be different. Tomorrow being at least sometime in 2026, you're going to see more use cases. And if I have anything to do with it, those use cases are going to be point of sale, e-commerce, and bill pay. But in the opposite order, I think bill pay first. The FIs made a little more sensitive to the e-commerce and point of sale, where bill pay, a lot of bill pay today is ACH and in other means. Some of it is back end wires, even when it's mass settlements through all the processors for bill pay on the back end, like RPPS and FIS and Fiserv have major efforts, and those are things that are behind online bill pay today. When we could talk about QR codes, I'll talk about how that can change, all the things that can change with that could enable. And when that enables it for not only for instant payments as well as ACH, but also stablecoins, it doesn't matter. That's where stablecoins will find their way. And it'll be up to the merchant or the biller as to what they accept. And maybe they'll have preference. They'll give more incentive to, if they feel that, they save more money, or they like the idea of receiving stablecoins as opposed to directly in their bank account. They may feel in their wallet, they may have better access to use of it. And at some point they become one. Your bank account, your wallet become one.
So a little bit more on the challenges. I did that same article that really had a dramatic increase over the past few months. I think it was from the Brookings Institute, and I skimmed it. I didn't read it. They indicated, well, there's things that can go wrong. Any thoughts on that? What traps can our financial institutions avoid as they look at this new ecosystem?
I'll talk about what financial institutions could avoid, but let me start with some of the traps or some of the problems from a consumer usage standpoint. So anyone that's ever tried a stablecoin transaction will know that it is not frictionless. It's not an easy thing to do. It's easy to make mistakes. You can send it to a wrong address, which is almost like imagine an email, but a lot more complex. You can send it on the wrong blockchain. You can use the wrong stablecoin. That complexity can be a real hindrance to consumer adoption. Now, we know that all technology over time gets easier to use, right? The early days of the internet were pretty complex, and now it runs in the background. So that's going to change. From a financial institution standpoint, the complications are, and where you could have failures would be probably around custody and security and stablecoin usage or tokenized deposit usage and where that's going. And is it with a sanctioned individual or an illicit activity? Those are the kind of things you'd worry about from a financial institution standpoint. The other thing to worry about would just be the complexity from a technology stack. You talk about applications, orchestrators and infrastructure providers. You've got liquidity providers out there. You've got the issuers themselves. You've got various blockchains. So it's fairly complex, and there aren't a lot of one-stop shops where you can go to get that type of solution. So it's a matter of, if you're a financial institution, you have to understand how are your users or members using this today? Are they using it today? How are they going to use it tomorrow? What's the volumes look like? What's the impact to our financial institution? What's the strategic importance of doing this over time? And then consider, those use cases and how you, from a strategic standpoint, you're going to build this out so that, it works with the existing monetary system and the existing banking system today.
As far as the challenges is what institutions have to be careful with in their planning is some of them may jump, say, well, how do I start issuing stablecoins or tokenized deposits? It's like, that's putting the cart before the horse. I mean, not only you need the strategy, but part of your strategy is before you can issue anything, you have to have an acceptance network. Well, who's going to be able to accept it? So you need the wallet providers, and we need a clearing and settlement ecosystem that, be able to convert it back to fiat. So some use cases that are currently people are used to, they're going to continue to be able to do, put it back in their bank account so that they can use it for the payments that they're using today, or, and certainly, be able to easily be able to issue or send it to, the people they want to pay based on how they want to accept it. So we talk about mistakes and the wrong things. Another topic under the QR codes is how it's going to help prevent those things. So I'll talk about that.
Let's jump into QR codes. Again, talking about the future is now. I remember the stories of folks would tell us they went to someplace international and there were no payments. They just had QR codes, and I could go up and buy, fruit using a QR code. And that was, that was like science fiction. It's not anymore, right? What's going on?
Right. So, QR codes are not new. In fact, they actually started exploding with, during the COVID time, where we were using QR codes for menus, and, nobody wanted to touch anything. You also would scan everything. And a lot of QR codes for payments, which is different. There's QR codes for not payment, things, but QR codes for payments, there's static versus dynamic codes. Static codes is like you walk up to something and maybe there's a parking meter, or there's somebody has a stand and says, "Yeah, you get this product and it costs this much. Here's a QR code for it." And that static code, the problem with it is that you're going to use your camera app, you're going to try to scan it. Well, you don't know if that QR code that a malicious website is going to try to take me to. And so with X9, tackled this together with like 60 other people from the industry that I've been a part of, that tackled it to say it has to be very secure. So the first security aspect is it doesn't work with a camera app. The QR code for X9 only works with a payment app that the user has been already authenticated user, and the apps are able to have appropriate certificates to be able to access the information. The information passed along is all done proper security methods that X9 is a master at. And the way it works basically is that a merchant or biller who wants to receive a payment, they give the transaction information or the bill information, feed it in to be able to generate a dynamic QR code. And that QR code is then either printed on the receipt or displayed on a terminal or printed on a bill. And the consumer is able to scan that QR code only in the payment app. And that payment app, now the first thing the QR code does is it retrieves the information about the transaction. And that's not in the QR code. QR code doesn't contain any of that information. It now has a secure communication between the app service and either the biller's service that generated the QR code or the biller might have generated themselves. Okay. So now that information, that's equivalent to a request for payment. That I have the transaction information that could be presented like e-bill presentment, or, you see your transaction on the screen. Do I okay it? Yes, I do. And now I have from that, I can execute that transaction, and it could be paid any of the ways that payment request information includes also all the payment acceptance methods and information to be able to settle that transaction through those payment methods. So if it accepts ACH, you have routing account number, same thing for FedNow and RTP. If it push to card is the method you want to accept a payment. If you're a micro merchant that has a debit card that has push to card capabilities, you might want to say that's what I want, how I want to accept it. Or you may say, I have a stablecoin wallet and here's my wallet address information. So the user never has to touch any of that information, never sees any of their information, but the service the app that they scanned it off of matches up any of the payment acceptance methods to payment send methods that they can do. And they may automatically do it for them, to do that match. And certainly all of them can push it via ACH, but, they're probably also going to be able to, if those who do FedNow or OTP send, they can do that. And if they've already been set up with wallets for their customers, they can push a payment to another wallet. Go ahead, Larry.
Sorry about that. I'm a huge fan of X9, but I also want to, especially as it relates to stable coins and probably eventually tokenized deposits, wallet transactions using your mobile phone, particularly the tap to go using the near field communications and the secure element, is something that opened up fairly recently, particularly with Apple. And there's a number of providers, Flexa, Circle, and others that are looking to bring that to the market. So the familiarity of tapping your mobile phone and having that transaction run off of your mobile wallet is here already and further being developed. So users are going to have lots of different options. So the X9, which again is a secure QR code, they're going to have tap to go. They're going to have things that feel very familiar that they do today, which will make that use case and user interface a lot easier than, say, it is today for most of those of us that are familiar in the crypto world with stable coins.
Well, I'm glad you brought that up, because this is really important. Because the design of the QR code, the message that comes across, and the information communicated with the QR code, it can be implemented through a tap to pay experience too. So all those payment methods I talked about can have a tap to pay experience. That covers pay by bank, that covers push to card, that covers pay to wallet, all with the same standard that is either scanned or tapped.
Great point.
So I did just want to recap, translate a little for folks who aren't, all up to speed. X9 is the ANSI standards organization. It's a subpart that talks about financial transactions. And, the same folks that define how far apart the screws on a light bulb are defining how a payment's going to flow. And this is not new, right? This is working off of an existing model. And I don't mind mentioning, is that Matera?
Yes. I mean, Matera has been involved in the X9 effort as well as the Faster Payments Council. And there's a collaboration between Faster Payments Council and X9. And so Matera is actually the firm that helped bring their experience of doing this already for billions of transactions a month in Brazil, where the instant payment methods there have been PIX, but now they're opening it up to stablecoins as well. And Matera is kind of leading the way there, and then trying to bring that experience. But through the X9 extension, and part of my influence is that we've gone a little further even than they've done in Brazil. And we're going to be able to do even more. We have a whole roadmap of additional capabilities that eventually include even line items, tax details, incentive options, refund options. And the sky's the limit on what this communication enables in this basically service-to-service communication between the app that scans it and the service that generated the QR code and has the payment and acceptance information that they're communicating.
Yeah, and I only know enough to be really dangerous, but this is not an idea. This is not fantasy from across the sea. This is a real payment mechanism that works today and is smart. It's not, it's not just like a check, right? Where there's information on a check, anyone can take a check. There's actually coding in the background, codes that tie this payment through ISO to other systems. It can be smart, correct?
It can be smart in terms of when the payment is made, the payment can go through the rails and carry the information like an ISO message. But also the X9 standard includes a payment notification message that says, here's what I've sent you. So if I sent you via ACH, I want to give you that notification. Yeah, I sent it to you via ACH, especially from a merchant. I know I'm going to get my money. So I know I'm not getting it, but yet I don't have it yet, but I know I am getting it. So payment notification could tell us that. But even with an instant payment, it helps with the reconciliation. The payment notification could have some additional information that doesn't necessarily come through the ISO message that the payment might have been paid through an instant payment or push the card. So, but you talk about programmable things in logic. And I'm sure Larry wants to talk about one of the major differences with stablecoins and tokenized deposits for programmable payments.
Yeah. So that is a big differentiator, particularly with interoperability and the ability to make money automated. And so think about all of the things that we do today where we involve people in the payment process and all of the steps and all the intermediaries and all of the failure points and places where fraud can get introduced. Well, as we move to programmable money, that goes away because we can automate a lot of that, particularly as we start to move into the world of agentic payments, where we're starting to turn payments over to the AI agents on our behalf. They need a way to do that cheap and efficiently because a lot of those transactions aren't going to be big dollar transactions. They're going to be small dollar transactions. Like say, if I was going to order from Amazon every month toilet paper, well, what's the flushest, cheapest toilet paper I can get? I'd turn that over to the agentic payment agent. And what kind of payment would I want to use for that? A cheap payment. Well, that would be stablecoins, which, those payment costs might be 2 to 3 basis points versus, could be 50 basis points or more, depending on the size of the merchant for that transaction through the card network. So I think agentic payments, we are going to see not only with traditional cards, but also with stablecoins. And so there's that connection there to the programmability component of it.
That was awesome. I am going to close now, and I'm going to flip my close because I'm going to set you guys loose. I think we should meet again and talk about agentic commerce because that is fascinating. But I don't want to, we could go another probably half hour. But I'm going to close. For the listeners, please share this. I think this is a great episode. I think you guys should come back not far from now to talk about that because that's fantastic. But it's been so good. Is there anything else either of you would like to share? Thanks.
Joe, if I could share some sources for valuable information, where to get some information on this stuff. I mean, our company, srmcorp.com, has a lot of white papers and blogs out there. A good one for tokenized deposits is the Regulated Liability Network white paper, or the RLN network. Also look at, and we didn't talk about it, but the idea of a stablecoin clearinghouse. There's the UBIX white paper. And then if you wanted to find some good information on stablecoins, look to the April U.S. Treasury report called Digital Money. That's another great source.
I'll add another resource, something we could talk about with the agentic payments that has to do with solving another issue, and that is irrevocable payments with instant payments and stablecoins. How do you get your money back? And there's a firm that I'm starting to talk to called Coinbacks, COINBAX.io. And they're addressing this issue, and it's very interesting how they're doing it. And it's really something that is also going to be a major factor in the adoption of instant and all types of instant payments.
Larry, I think I'm sorry, Larry. Sorry, Steve. I think that warrants can you define a little bit more about why irrevocability is an issue?
Well, so if I sent the money, I can't call the FI and say I need to get the money back. You could say I was scammed and all that, and they may be able to try to help you get it back, but it can never be pulled back. The only way to get it back is like in a cash transaction. How do you get your money back in a cash transaction? You got to go back to who you gave the money to, and you got to ask them for it and hope they give it to you. Now, that's where you want some rules of the road that in every transaction, originally initiated transaction, that request for payment data should include what are the refund terms. That's one of the things I'm going to make sure gets into a future version of the X9 standard is the refund terms. I've shared that concept with them. And the refund terms would say whether or not the refund should be sent. It doesn't force it to be sent. Then if it's not, if it was able to be sent and wasn't done, then an intermediate can get involved to say, hey, you were legally supposed to be able to return these funds according to your terms. Why didn't you do it? And, then they can go after, they can try to talk to the FI on the other side and say, this party's, irreparable and causing harm to our customers.
And am I wrong? Could someday that be an agentic commerce discussion between two AIs?
Yes.
Yeah, absolutely.
Amazing.
Absolutely. Hey, well, one more thing.
We're going to have fun with this topic.
Steve and I would be remiss if we didn't add one more resource in there, which was the U.S. Faster Payments Council. It's a great source for all of this, whether it's X9, whether it's stablecoins, tokenized deposits, traditional faster payments like RTP and FedNow. It's really a phenomenal organization, and Steve and I are both blessed to work with that organization.
Yeah, a lot. I've been involved in that, in many papers and blogs coming out, and other resources as well that Larry and I collaborated on them, and each of us have collaborated with many others on lots of deliverables. So great resources there. I can go on and on just talking about that. And of course, there was my Smart Instant Payments book that originally talked about the vision of some of this and has some details about the instant payments in general.
Yeah, no, that's part of my content for the AFPP certification. I know the article or the chapter on ISO was fantastic. So it's all good. All right. Thank you very much for joining me. This is great. I can't wait
to having us.
Yeah, thank you for having us. We really appreciate it.
Oh, thank you. Thank you. Thanks. Bye.
On behalf of Niche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of niche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.